Question number 10. Some assets and liabilities not taken over. Balance sheet is given. So purchasing company is not taking over all the assets and liabilities. Some assets and liabilities left over while absorbing, while taking the other company. X Limited was wound up on 31st March 2024 and its balance sheet as on the date was given below. And notes to accounts also given. Y Limited took over the following assets at value shown below. Non-current assets for 12 lakhs 80 and stock 770, PR 30. And purchase consideration was settled by Y Limited as under 5 lakhs 50,000 of the consideration was satisfied by the allotment of fully paid 10% preference shares of rupees 100 each. Right. The balance was settled by issuing equity shares of rupees 10 each at 8 rupees per share paid up. Clear? So, what are the assets taken over? They have taken over only few of the assets. Non-current assets taken over for 12.8 lakhs. Stock taken over at rupees 7.7 lakhs. BR 0.3. What's the overall value? 20.8. Out of that, 10% preference share capital being 5.1 lakh. 5.1 lakh. Right. Balance being equity share capital. How much is that? 15.7. This is in lakhs. You can even calculate the number of preference shares as to equity share capital. 5.1 per preference share costing rupees 100 means how many preference shares may be there? 5,100 preference share may be. For equity share capital, 15 lakh 70,000 rupees for every equity share. The paid up value being only 8. So 15 lakh 70,000 rupees divided by 7, 8. What's the value? 1,96,250 equity shares are offered. That's all. Sundry it has realized 1 lakh at 1 lakh 50 and bills payable settled for 38,000. Income tax authority fixed the taxable liability at rupees 2 lakhs 22,000. Creditors were finally settled with the cash remaining after meeting liquidation expenses amounting to rupees 8,000 rupees. You are required to calculate the number of equity shares and preference shares to be allotted. We have done this one. Prepare realization account, cash and bank account, equity shareholders account, and Y Limited account in the books of X Limited, and pass journal entry in the books of Y Limited. Is that okay? So as usual, you have to close the books of accounts here by preparing realization account and purchase consideration, purchasing company, Y account, and then what are the shares are there? We have the equity share capital, so equity shareholders funds account and cash. Because some of the assets and liabilities not taken over, those things are settled outside the agreement between these two. Any amount realized could be used for settling the dues. Right. Let's start now. Realization account. Realization account of X Limited. Their balance sheet is given here. Apart from that, the additional items also be available here. If nothing stated, we can assume we have to follow which method? We have to follow only purchase method. The realization account and then purchase consideration account. Rather than that, what we can do, cash and bank account, equal shareholders account, and Y limited account. That's all. You no need to open the purchase consideration account here. So realization, purchasing company being Y account, Y account, and then equity shareholders account. Better to open the cash account also. Open the cash account also. Right. Cash. What you have to do? Record the balance sheet items first. Let me finish up the things available in the notes to accounts. Thereafter, I will incorporate the balance sheet rest of the items. Reserves and surplus, profit prior to incorporation, contingent reserves and profit and loss. Everything will be transferred to the equity shareholders account by equity share capital. Apart from that, all the reserves and surplus will be transferable here. Profit prior to incorporation. Profit prior to incorporation. Value being 42,000. And contingent reserve, the value being 2,70,000. Profit and loss account 2,52,000. You can join with me to solve this illustration. Come on. You know the provisions and steps. You can join with me to solve this. In current liabilities, under creditors by creditors should be transferable to the credit side of the realization account. The value being 2,26,000. This payable 40,000 rupees. And provision for income tax, value being 2,20,000. And we have been given the assets to stock 7,75,000. Debtors 1,60,000. And provision for doubtful debt should be the other side. Always remember, in case any provisions for any assets should be shown at its own original value. Any provisions on that should be posted at the other side. So here provision for bad debt being 8,000, BR being 30,000, and cash and bank, we have cash and bank account, so we can directly write here to balance. This value being 3,29,000. With that, I have completed posting the notes to accounts. Leaving that, other items, probably assets and liabilities in the balance sheet, could be now posted here. Shareholders' funds, equity share capital being 12 lakhs. And resource and surplus schedule number 1, from there we have already posted. Current liabilities schedule number 2 also be posted here from the schedules. Non-current assets to be posted here. Non-current assets 9,64,000. And current assets were already posted. This one already posted. Clear? Now, I am going to incorporate the purchase consideration here. And what are the assets and liabilities taken over by the purchasing company? These are the list of the assets and liabilities taken over. So the purchasing company offers the purchase consideration of rupees 20,80,000 only for 3 assets. For what are the assets they are offering this? Non-current assets, stock, and BR. For these 3 assets, purchase consideration payable by Y Limited being 15 lakhs, sorry, 20 lakhs execution. Is that clear? The other unticked item, maybe settled later on separately. I'll do that later on. So first, let me finish up all these things. So the purchase consideration being 20.8 lakhs is payable by Y Limited. So here to purchase consideration. This value being 20 lakhs 80,000. And the mode of payment being 10% preference share capital as well as equity share capital. 8 rupees paid up, the face value being 10. So 5.1 lakh and 15.7 lakhs. The purchase consideration settled by Y Limited will be offered to equity shareholders. So I transfer here. Equity share capital and preference share capital. Capital offered here being 15 lakhs 70,000. 15 lakhs 70,000. And preference share capital being 5 lakhs 10,000. So with that, we have completed all these items. Clear? Now, what about the other leftover assets? Debtors, along with the creditors, bills payable, provision for doubtful debts, and PDD. As these assets and liabilities not taken over, yet it should be settled outside. So for that, the information is given here. Okay, this part, B and C. These are the two items are going to be incorporated here. Clear? Let me incorporate these things. What happens here? Sundry debtors realized 1,50,000. Debtors, by realizing you get the cash, so bank. For what? Debtors. The amount realized by settling the debtors being 1,50,000. I put the tick mark for the debtors, meaning that this one is recorded. While putting the tick mark for the debtors, don't forget to tick the PDD also. It should also be cancelled. So ultimately, all the assets and liabilities should be cancelled on closure. Okay, still we have the creditors, bills payable, provision for taxation remains unsettled. Now I'm going to discuss those points along with the adjustment number E and C. Bills payable was settled at 38,000. So this one settled. So here bank. All these things are from adjustment should be posted twice. The another one should be posted in the cash account. I will do it later on. So here bills payable. This value being 38,000. Actually, bills payable as per the books is 40,000 rupees, but the payment is only 38,000. As we are paying lesser, it's a gain for us by 2,000 rupees. Income tax authority fixed the taxation liability as 22,000 finally. So tax payment, income tax payment. As per the books, it is 2,20,000, but final payment comes around rupees 2,22,000 rupees. And creditors were finally settled with the cash remaining after meeting the liquidation expenses. So we have to make the payment to the creditors also, and there is an expenses for liquidation purpose. The liquidation purpose expenses being 8,000. Now the question is how much we paid for the creditors. That is silent. What are the cash balance finally available is used for settling the creditors. That's how the statement is given. We have to find out the cash balance. For that, we have to finish up posting the bank related thing. By realizing creditors, debtors, we get 1 lakh for that debtors. And by realization for various payments. For what are the payments we do? Bills payable, 38,000. For income tax purpose, we make a payment of 2,22,000. And for expenses, we paid 8,000 rupees. Whatever the balance left over, no, that is for creditors payment, balancing figure. Come on, get me the value here. So this will be 4,79,000 in the debit side. 4,79,000 debit side. What's the final balance here? Creditors balance. Come on, make it faster. Is it 2,11,000? Yeah, 2,11,000 is the final payment to the creditors. With that, all the dues were closed. Only this remains unticked. By ticking this, we confirm that the payment for that one also be over. Now finish up carrying the realization and find whether there is any profit or loss. Hope now you'll be getting profit. I think the total of the credit side being 24 lakhs, 27 lakhs, 24,000 and 27 lakhs, 24,000. Right. The balance what you get is for equity shareholders. How much you are getting the balance here? Hope it is 3 lakhs 16,000. Am I right? Cross verify that. This value will be transferred to the equity shareholders. Realization profit 3 lakhs 16,000. 3 lakhs 16,000. I don't want this anymore. Okay. So 3 lakhs 16,000. If you tally the equity shareholders account, it should get tallied. Right. So the value being 20 lakhs 80,000. Hope it is now tallying this. 20 lakhs 80,000. And cash total also be calculated. Apart from that, we have to now post the entry in the books of buyer. Who is he? Y. So Y book. 3 journal entries should be passed. Journal entry number 1 is all about business purchase. Business purchase account debit to liquidator. To liquidator of X. Liquidator of X. Isn't it? The value being 20 lakhs 80,000. 20 lakhs 80,000. Second entry being this business purchase is now replaced with various assets and liabilities taken over. Purchasing company takes over only 3 assets. So those assets are being non-current assets, debit 12 lakhs 8,000 and stock debit 7 lakhs 70,000. BR debit 30,000. To the final payment being the business purchase. I think there is no profit or loss in acquisition. There is no profit or loss in acquisition. Clear? Okay. The final entry being make the payment to the liquidator of equity share means X company. Liquidator of X account debit. The payment being in the form of 10% preference share capital as well as equity share capital. Weight 8 rupees paid up for 10 rupees face value shares. This value being 5 lakhs 10,000 and equity share capital worth being 15 lakhs 70,000. Overall payment being 20 lakhs 80,000. 20 lakhs 80,000. Hope now you'll be able to understand the complete thing. Clear? Now let's move on to the next illustration. With that, all the concepts are over. Tomorrow we'll plan for a test. Get ready for that. Okay. Internal reconstruction as well as this one. These two chapters put together will have a lengthy test, right? So from 10 to 1, 3 hours test. Okay. Get ready. Now let's move on to the next one. If it is clear, text me. We'll move on to the next question. Any doubts here? 11th question. Online students, come on, text me. Online students, I request you to answer me. Now, let's move on to the next one. You have to understand the concept of fractional share. This question number 11 is one of the interesting illustrations. Okay, it was asked in final, sometimes stated in inter. The main requirement in this question is to calculate the purchase consideration. Only for purchase consideration, 16 marks awarded. You have seen the lengthy illustration, isn't it? Okay, calculate purchase consideration, close the books of the transferor company and pass the books of transferor company and incorporation journal entry in the transfer and balance sheet. That's sort of a complete structure. But from that structure, one or two aspects only may be expected for 60 marks in your examination, most probably. But this question is very interesting because until that time, I have not seen a comprehensive illustration for 16 marks about calculation of only purchase consideration. So one of the beautiful illustration, only purchase consideration, 60 marks. Right. Z Limited agreed to absorb Gulf Limited, whose balance sheet stood as follows. This is the balance sheet of Gulf Limited. The consideration was agreed to be paid as follows. A payment in cash of rupees 50 per share in Gulf Limited. Right. How many equity shares are there? 80,000 shares are there. 80,000 equity shares are there. Right. Now the purchase consideration being cash payment is there. If you are a holder of one share in Gulf, you will be getting 50. For 80,000 shares, what could be the cash payment? Come on, tell me. 40 lakhs, am I right? 40 lakhs will be the cash payment. The issue of shares of rupees 100 each in Z Limited on the basis of two equity shares valued at rupees 150 and 10 rupees cumulative, 10% cumulative preference shares valued at rupees 100 for every 5 shares held. So if you are holding 5 shares in Gulf, okay, this is what about 5 share capital of Gulf. You will be getting rupees 50 cash as well as you will be getting equity share capital rupees 100 each. How many numbers of equity shares you are getting? 2 equity share capital. So equity share capital of purchasing company Z company's equity share capital. Per equity share capital having face value rupees 100 means for 2 share it is 200 rupees. Apart from that, the real value of the share being 150, 50 rupees is excess, which is nothing but securities premium. And per share 50 rupees securities premium, for 2 share it should be 100 rupees is equal to the securities premium. Apart from that, 10% cumulative preference shares valued at rupees 100 is also offered. How many preference shares? 1 preference shares is offered for every 5 shares. So that will be again another 100 rupees. This is preference share capital. 50 rupees is for per share for 5 shares. For 5 equity shares, the cash being 250. So if you are holder of 5 equity shares in Gulf, you will be getting 250 rupees cash, 2 equity share capital being 200 along with the securities premium, another 100 you will be getting. Not only that, you will be getting 1 preference shares value rupees 100. So what will be total net worth you are able to get here? Probably 650. For every 5 shares being the holder in G Limited, you will be getting 650 rupees worth the shares. Is that okay? What's the benefit? And it was agreed that Z Limited will pay in cash for fractional shares equivalent at agreed value of the shares in Gulf Limited. So if we are not able to offer the comprehensive 650 rupees for the 5 shares, if you are being only holder of 4 shares, how will I be able to offer this one? Unless you hold 5 shares, you are not able to get this benefit. If I am holding only 4 shares, I cannot offer you, isn't it? So you need to be the holder of 5 shares to enjoy this benefit. If you are holding odd number means maybe 4 shares, or 3 shares, or 2 shares, or 1 share, you will not get. In that case, you will be given equivalent cash benefit. It means for 5 shares of Gulf Limited, you will be getting 650 rupees worth. Having this breakup, it means for every 1 share, you will be getting 150 rupees. Okay, per share, per equity share capital, isn't it? This is what about the case. See, if you are holding only 1 share, you are not able to get this bunch of shares and bunch of benefits. Then what you can get? Only 150 rupees. If you hold 2 shares, you will get 150 to 300 rupees. If you hold 3 shares, 450 rupees cash. 4 shares, 600 rupees cash. If you hold 5 shares, you will get this benefit. So if you hold 5 shares, you will get 250 rupees cash and 2 equity shares and 1 preference shares. If you hold 6 shares, what happens? For 5 shares, you will get this bunch. For 1 share, 150 rupees in addition. That's called fraction shares. Is that clear? Now, cash 40 lakhs, and apart from that, these benefits also be offered. These benefits also offered. The whole of the share capital consists of shareholding in exact multiple of 5 except the following holders. So all the shareholders holding in exact multiplication of 5, definitely they will be getting 650 rupees worth of benefits by way of cash, equity shares as well as preference shares. But these 5 shareholders are not having the exact multiples of 5. In case of Bharti, he holds 116. 116 means how many 5 shares are there? Maybe 116 divided by 5. 115 will go off. 1 will be the remaining share. 1 will be the remaining share. Is that okay? That odd number being a fraction share being only 1. In case of Sonu 76, 75, okay. 1 odd lot will be there, 1 share. Hitesh 72. You divide that by 5 and there will be remainder 2. That remainder 2 will be the fraction number of shares. In case of Jagat 28, 25 okay. 5 times it's 25 okay. 3 will be the means odd lot. For that we cannot offer this bunch only. 150 rupees will be offered in cash for every share. And other individuals, 8 shares, 8 members holding 1 share each. So all the 8 will be the odd one only because 8 persons are holding only 1 shares. So overall, what happens here? 15 shares in trouble. Okay, 15 shares. Is that okay? So 15 shareholders could not get the bunch. If all the 15 held by 1%, then of course this will work. It is not so. Now, out of 80,000 shares, is that okay? 15 shares are called fractional shares. For them, we are offering 150 rupees each. What's the value? This is what about the cash benefit. This is what about the cash benefit. What about that? 2,250. Apart from that, balance being how much? 79,985 shares. For that, you can allot what? First one being cash. 79,985 for every share, 50 rupees cash will be offered. How much is that? Come on. 39 lakhs 99,250. 39 lakhs 99,250. Is that okay? Cash. Apart from that, equity share capital. 79,985 shares. Okay, 2 equity shares offered for every 5 shares held. The face value being 100, and securities premium will also be there the same way 79,985. 2 equity shares offered for every 5 held, but securities premium being 50. Come on, get me the value for equity share capital. 31,99,200. This one is 130, yeah? Okay. This one being 130. Then this is 130. Come on, tell me this value then. Okay. This is 130. 130 into 50, 1,950. What is the value for equity share capital? How much? 31 lakhs. 99,000. 4? Okay. Next one being half of that, right? 50%. 15 lakhs? 99,700. Apart from that, we have to go for the preference share capital. For every 5 shares, 1 share will be offered. Isn't it? And that too, the value being 100 rupees. The value being 100. Then this value being 13. 15 lakhs. 99,700. Now get the total. 1 crore 4 lakhs. You can cross verify. For every share, the benefit offered being 600. For every 5 shares, the benefit offered being 650. Otherwise 130. 80,000 into 130. Do you get this value? It's a for cross verification. That's all. Now the cash benefit alone, You can add up these two to find out the cash benefit. How much cash benefit is there? Yes.
40 lakhs, 1,000.
40 lakhs, 1,200. Okay. Now you get the cash benefit separately. This question was one of the fantastic illustration when it was asked very first time. Because no one knows what is called fraction share. This is the exact concept of fraction share. Okay, it's not overall number of shares divided by the value calculation. So if you are calculating this with 80,000 share, if I divide this by 5, there is no fraction. No, it's not so. Fraction share will be the shares held by the shareholders. For them, we cannot allot the purchase consideration. Okay, clear? If it is clear, text me. With that, all the concepts are over. Now we'll start with additional problems.
Sir, 130.
650 is the overall value for 5 shares. Then per share benefit being 130. If you are holding 5 shares, you will be getting cash, equity shares, securities premium, preference shares. So the benefit for the 5 shares being 650. If you are holding only 1 share, then naturally it is 130. 650 divided by 5. We have completed all the aspects now. All the aspects. Let's summarize. So amalgamation as per AS number 14. This AS of 14 is applicable only for the buying company, transferring company, not the selling company. The amalgamation could be of in the nature of amalgamation or merger or purchase. If you feel that it seems to be merger method, if you confirm it's being the merger method, pooling of interest method will be adapted. In case the amalgamation being the purchase method, the method of accounting being purchase that we referred in the very beginning class. All these models will fall under AS number 14 only, where n number of existing company merged with the newly formed one company, where all the companies are closed. This was earlier called as amalgamation. Here, minimum two companies will be closed, minimum, maximum any number of companies, and formation of new company exists. And earlier we call, if one of the leading company takes over all other companies, all other companies may be closed. From this it is very clear, at least one company will be closed and sold. One company will sustain and there is no formation of new company. This part is called absorption. And the company closed and newly formed company will take over that company with a new image. That will be called external reconstruction. All the three aspects will be coming under amalgamation as per AS number 14. Okay, the internal reconstruction will not be falling under AS number 14. We studied that separately. Clear? And to call the amalgamation may be in the nature of merger, there should be 6 conditions fulfilled. Okay, there must be 6 conditions to be satisfied. All the assets and liabilities now becomes the assets and liabilities of the transferring company. 90 plus the shareholders of the transferor company becomes shareholders of the transferring company after the amalgamation. There may be some dissatisfied shareholders. It may be less than 10%. It should be settled somehow. And the consideration is settled by way of equity shares only, mostly. Equal and equal shares may be offered. And the transferor business should continue even after the amalgamation. And we should continue to appear the assets and liabilities at its own book values. And even we maintain the resource and surplus also. If we are able to satisfy these 6 conditions, then automatically it will be considered as merger. Okay? Non-compliance with any condition nullifies the merger classification, automatically becomes purchase method. The predominant steps to solve these kinds of illustration being the first step, calculation of purchase consideration, second being close the books of the transfer company, and pass journal entry in the books of incorp means buying company and prepare the new balance sheet. So these are the 3 predominant steps. In the very first step, calculation of purchase consideration, we may have around four methods. One is lump sum method, another one is net assets method, another one is net payment method. So finally, we have the intrinsic value method, otherwise it is named as share exchange method. So I have just explained with an illustration of all these four methods of purchase consideration calculation. That first part is over. In step number 2, we just to open the ledgers. What we do? Close the books of accounts. Which accounts? Transfer to company's account. So for that, step number 1, open the ledgers. So what are the predominant ledgers we usually open? Realization account, purchase consideration account, purchasing company account, and equity shareholders of the selling company. If needed, you can, of course, need to open the preferred shareholders account also, and sometimes you need to open the bank account also. In the last illustration, we have seen opening the cash account also being required. And once it's open, next is close the balance sheet. So second step, record the assets in the debit side of the realization account, and liabilities will be shown in the credit side of the realization account, and equity shareholders funds will be transferred to the equity shareholders account. Okay, that's how we can close the balance sheet items. Step number 2. Step number 2, then we'll go for incorporation of the purchase consideration in step number 2 itself. So purchase consideration will be posted in realization account, purchase consideration account, and purchasing company account. The mode of settlement, how this is distributed to various contributors. So these are the steps involved, right? So I just explained realization account, purchase consideration account, purchasing company account, and equity shareholders account. Here you write purchase consideration, and this is transferable here and here and here. These are simple steps you can keep in your mind. And some special adjustments. Assets and liabilities sometimes not taken over by the purchasing company. If the assets and liabilities not taken over by the transferee company, will be settled, routed through the bank account. So that's how we solve one illustration. And the mode of handling the realization expenses made by the transferor company or transferee company, or sometimes a portion by transferor, portion by transferee, or sometimes it may be spent by the transferor, later reimbursed from the transferor by equity share capital. Okay, usually purchase consideration may be paid in the form of equity share capital. Then it may be recorded at face value or issue price. Issue price means face value and securities premium can also be considered separately. If you are showing the face value and securities premium together, then the purchase consideration value is higher, right? If you are showing the purchase consideration at face value only, then the purchase consideration may be lower, will have the impact in the capital or goodwill or the adjustment in the profit and loss in case of merger. Finally, after this, you can directly go for closing the ledgers. Realization account, transfer of profit and loss to equity shareholders if there is any profit and loss. And purchase consideration, purchasing company, finally, if you close the equity shareholders account, it will be getting tallied. If needed, preferred shareholders account, bank account also. Sometimes we may open the preferred share capital as well as bank account. If that's so, you have to close those two accounts also. Okay. So then you have to pass the journal entries in the books of transferring predominantly after the amalgamation. Three predominant journal entries. One is all about business purchase. Next one is taking the assets and liabilities. Third one is settlement to the liquidator. Under purchase method, we have to record at the realizable value, and the profit and loss will be shown in the goodwill or capital reserve. In case of merger method, you have to show all the assets and liabilities at the book value. Even you are recording the reserves and surplus also. Okay, reserves and surplus also intact. Where because of purchase, if there is any profit or loss, will be adjusted only the reserves and surplus. These are the points you have to keep in your mind. And apart from that, this one note. Okay, we have completed this one also. Then, in case of statutory reserve. Okay, refer entry. Under pooling of interest method, no adjustment required, but under purchase method, in case of statutory reserve, on creation, amalgamation adjustment to statutory reserve account will be credited. That's a journal entry. And how this will appear in your balance sheet? See, under reserves and surplus, statutory reserve will be shown in the inner column. Amalgamation adjustment account will be shown in the inner column in brackets. Ultimately, the value will be 0 only. A few years you have to retain as per the legal requirement. After the legal requirement is fulfilled, sometimes later you no need to show. To reverse this, you can pass the reverse entry of this, so that the statutory reserve may be cancelled completely. And apart from that, any debenture issue to the equity shareholders is a part of purchase consideration, but anything offered to the debenture holders is not part of purchase consideration, so only settlement of debt. You have to keep that in your mind. We have studied that one also. And calculation of purchase consideration format is also given here. See. Now, equity shareholders, transferee being equity shareholders, transferor being equity shareholders. Preference shareholders, further preference shareholders benefit is given. Debenture from the transferor company, the benefits are transferred. What are they? Equity share capital, preference share capital, debentures, and bank, whatever it may be. You have to add up all these values being the part of purchase consideration. If the equity share capital is offered to the equity shareholders, preference shareholder capital offered to the preference shareholders, debenture offered to the debenture holders. This debenture is offered to whom? Equity shareholders. This debenture is offered to whom? Debenture holders. Then what about the purchase consideration? This part is not purchase consideration. Only 5,500 and 250,750 will be the purchase consideration. Anything offered to the debenture holder is not part of purchase consideration. But if the debenture is offered to the equity shareholders, then it's part of purchase consideration. You understand now? So this one also we consider already. And realization expenses also we have studied. The expenses made by selling company or purchasing company, or a part by selling company, a part by purchasing company, a combination there. The last one being selling company incurs, later it is reimbursed from the purchasing company. So these are the scenarios we have studied along with the realization expenses. That's all. Apart from that, we have studied intercompany owings, mutual owings, otherwise named as mutual owings, debtors and creditors cancellation, BR and BP cancellation. While cancelling the BR and BP, you have to consider if there is any discounted bill or endorsed bill. To that extent, we cannot cancel, right? Now the bills discounted with the banker is in the hands of the banker. If it is endorsed, it's in the hands of the creditors. That is not mutual cancellation, mutual owing, so that cannot be cancelled, right? And loans and advances and borrowings, these are the intercompany owings possible. Apart from that, we have the unrealized profit and unsold stock. Okay, in case if such stock is included in the inventory of the selling company, okay, yes, D. So, if the stock sold by buying company to selling company, cost being 1,000 and profit 200 rupees is added and stating this value being 1,200. In that case, in selling company's balance sheet, it should be this 200 should be reduced from the stock value as well as reduced from the profit and loss account also. But if the goods sold by selling company to the purchasing company, buying company, okay, selling company and okay, including the inventory, okay, I made a mistake, including the inventory of the selling company, okay, this will be the buying company, buying company and selling company. In this case, what we have done is correct. If the buying company goods included in the selling company, what happens? While passing the journal entry, you can undervalue that. That's okay. Okay. So the stock is valued at its own original cost by excluding the unrealized profit. When if the goods are transferred from buying to selling, that's how you can understand this one. Share exchange ratio also we have studied sometimes. 10 rupees shares, 10 rupees debenture holders are offered 12% debentures, but same interest rate is maintained. In that case, the exchange ratio can be calculated this way: old ratio divided by new ratio to the face value. So these are the cases only we have studied in all the cases. Also, okay, if you are mastered with this one, then you are thorough with this chapter. Some disclosures in the first financial statement immediately after the amalgamation, the very first year. You have to give all these details. What are they? Number one, names and general nature of the business of amalgamation. Nature, purchase or merger. Effective date of amalgamation, from when the amalgamation will work. Third, the method of accounting used to reflect the amalgamation. The method of accounting. Fourth, particulars of scheme sanctioned under the statute. So all these things you have to disclose while presenting your financial report as per AS number 14. Additional disclosure also you need to show. Additional disclosure, have a small view with this. So with that, all the concepts are over. And practical problems may be expected on purchase calculation of purchase consideration, absorption related, amalgamation related, some basic and advanced sums along with the purchase method and merger method, handling the unrealized profit and fractional shares and all. So we have completed all the aspects. Is that clear? Any doubts? Okay. So what I tell you about these calculations part and steps in the very beginning, no, master it. Okay. So that is the core. Once you are strong with those core, you can solve few illustrations, then you become master any number of illustrations if you are facing, you don't have any problem. You don't have any problem. Is that clear? Okay, then let's go for the additional problems. So with that, all the concepts are over. Before I wind up this chapter, we'll see some illustrations, additional illustration. I may start with one illustration. The next class I will complete fully. Okay. Yeah. Let's see. What happens here? Anurag Limited and Sagar Limited were amalgamated on and from 1st April 24. A new company, Anusha Limited, was formed to take over the business of existing companies. So these two companies are merging with new company, Anusha. Anusha, is that clear? Now, additional information. 10% debenture holders of Anurag Limited and Sagar Limited discharged by Anusha Limited, issuing such number of 15% debentures of ₹100 each so as to maintain the same amount of interest. Same amount of interest. Then automatically what happens? Old rate divided by new rate will be followed. But anyhow, the debentures offered to the debenture holders is not part of purchase consideration. It's only settlement of debt. It will have the impact only in the purchasing company, not here. Right. Now, into this is 10% and 15% will be the new rate. So into 10 by 15. Naturally, what happens? This will be 40, this will be 20. Am I right? This will be the new issue. New issue. Right. Preference shareholders of the two companies are issued equal number of 15% preference shares of Anusha Limited at the price of ₹150. So it's a part of purchase consideration. Preference share. Okay. 1:1 ratio, equal numbers. But the new issue will be having face value 15, rate being 15% dividend rate, face value 100, and securities premium on that being 50. Okay. These are the two items. Now, 800, Anusha and Sagar. 1:1. 800, you get same 800. 750, 750. 50% on that being the securities premium, so 400, and this will be 370. Am I right? Investment allowance reserve is to be maintained for 4 more years. So, amalgamation adjustment account should be opened here. That too be only in the books of purchasing company, not here. Okay. Anusha Limited will issue 5 equity shares for each equity shares of Anurag. Preference shareholders of the two companies. Okay, okay. This is for preferences. Okay, fine. And this will be the preferences. 300 and 200. 50% being the securities premium, so 150 as well as 100. Apart from that, for the equity shareholders, they will be getting 5 equity shares for each equity shares of Anurag Limited. Okay, equity share capital. Okay, so 100 rupees shares. But this share being only, okay, the shares are to be issued at 30 each, having the face value 10. 10 rupees is the equity share value, and 20 rupees is the securities premium on that. For this company, 5 equity shares for every shares. 5 for every share. You have to divide this by 100. You will get the number of shares. You will get the number of shares. 8 number of shares. 5 will be offered for every one. 8 into 5, 40. 40 into 10, 400. Securities premium being 2 times of that. So 800 rupees will be the securities premium. And 750 lakhs. Share price being 100. Naturally, what happens? You will be getting 7.5 lakh shares for Sagar. 4 equity shares are offered for every shares. So into 4 by 1. Okay, sorry, into 1 by into 4 by 1. Is that okay? 30. So 30 shares, face value being 10, 300. Securities premium being 2 times, because 30 rupees is the final issue price, 10 rupees is the face value. The difference between these two, securities premium being 20. Face value 10, securities premium 20, 2 times. So 300 means securities premium should be 600. No more information is available here. That's all. So we have completed the purchase consideration also. Right. The purchase consideration in this case being how much? 1650 for A, and for B 1200. Okay. Prepare balance sheet of Anusa Limited as of 1st April 2024 after the amalgamation has been carried out on the basis of amalgamation nature of purchase. So you are not asked to pass journal entry or purchase nothing. Directly you have to prepare a new balance sheet, right? So let's start with. Yeah. This one. I'm going to prepare the balance sheets right away. Investment allowance reserve to be maintained for how many years? 4 years. Investment allowance reserve 100. Amalgamation adjustment account 100 negative, so it becomes 0. And as we follow which method? Purchase method. You cannot maintain any of the resource. But in an inner column, investment allowance reserve 100, and in inner column itself, amalgamation adjustment account in brackets show 100, so it becomes 0. You have to show. So the resource and surplus will appear this way. Resource and surplus. Okay, schedule number 1. Investment allowance reserve 100, amalgamation at 100 negative. Outer column we have to show at 0. Clear? Apart from that, sundry creditors remains unadjusted 390. Bills payable 220. Land and building, there is no any revaluation of assets and liabilities. We assume the book value remains maintained correctly. So 950 and 600 rupees for the plant and machinery, 200 for the investment, stock 600. I'm just adding all the items line by line. Sundry debtors 550 and bills receivable 100. Cash and bank be 500. Is that clear? Clear? Now, this value being schedule number 2 value being 610. What about the value of non-current assets? 1750. What about this value, current assets? 1750. I'll show all this value here. 610. This will be now 40 and 20. This is 60. And resource and surplus, we have to write it later on. And wait, this one. What I do here? Preference share capital being 500 and equity share capital being 700. Securities premium being 1400 plus 250, 650. So that will be a part of resource and surplus. So here securities premium 1650. Clear? 1650 will be the resource and surplus. Schedule number total being 610. Schedule number 3 total being 1750. Schedule number 4 total being 1750. Hope these two are the same value, 1750. Right. Now the problem arises to find out whether there is a goodwill or capitalism. As per the schedule number 1, you have how much? 1650. You have 1650. Clear? This being 1650. Come on, total the assets and liabilities and check whether it is tallying or not. Clear? I just did line by line addition. If it is not tallying, there will be capital or goodwill. I am waiting for that. Is it tallying or not? Which side is higher? Asset side how much? 3,500. 3,500. How much shortage is there? You have to include 1650 also here. After including 1650, what is the shortage? Only 20. Then it should be 1670. Am I right?
Sir, liability doesn't include.
Yeah, tell me. You missed to add this, right? This is.
Total 3,000.
Wait. This is 1650. Then what about the total of liability side?
3,520. 3,520.
3,520. 20 rupees shortage maybe could be. How can I calculate this, sir? How can I calculate this? For the calculation of goodwill or capital reserve, okay, what about the purchase consideration for these two? 2,850. 2,850. What about the net worth of these two companies? Net worth is nothing but all the values, the amount meant for the equity shares for shareholders as well as preference shareholders. Okay, equity share capital 1,550, preference share capital 500, reserves and surplus 750.
2,800.
2,800. So you are paying 50 rupees more, 50 rupees being the loss. Apart from that, you are paying lesser to the debenture holders by how much? 60 plus 30, 90, but you are offering only 60. Because of that, you save profit on settlement to the debenture holders 30. Ultimately, your loss being 20, loss on purchase consideration is always named as goodwill. Hope you will be now able to understand the calculation of this 20 also separately. If you pass the entry, okay, you will get the balance and you will name this being the goodwill or capital reserve, but it's not asked for. If the purchase, this one is not asked to, don't worry about to calculate all these things by passing the journal entry. It's a time waste. What the question is asked, you just try to answer that one alone. So in that case, I just merge all these things as the information given here and finding the balance as goodwill or capital reserve. For my satisfaction, I can find out the goodwill or capital reserve separately as a working. For my satisfaction. Is that clear? Hope now you'll be able to understand. Come on, make a note of it. So we have solved this illustration for a matter of 10 minutes. With the explanation. With the explanation. Is that okay?